Our next presentation is focused on the economics of international tax reform. The discussion is going to compare and contrast the presidential candidate proposals for tax reform and provide insights and perspectives into various possible reforms that we may see in response to the global tax climate change. Our speakers today include leading economists Eric Toder and Alan Viard. Eric Toder is an Institute Fellow at the Urban Institute, and he's co-director of the Urban Brookings Tax Policy Center. Dr. Toder previously was the Deputy Assistant Secretary for Tax Analysis at the U.S. Treasury Department. He was Director of Research at the Internal Revenue Service, Deputy Assistant Director for Tax Analysis at the Congressional Budget Office, and also consultant to the New Zealand Treasury. Alan Viard is a resident scholar at the American Enterprise Institute, where he studies federal tax and budget policy. Prior to joining the American Enterprise Institute, Alan was a senior economist at the Federal Reserve Bank, visiting scholar at the U.S. Department of the Treasury's Office of Tax Analysis, a senior economist at the White House's Council of Economic Advisors, and a staff economist at the Joint Committee on Taxation of the U.S. Congress. Alan also was formerly an adjunct professor at NYU Law School. Gentlemen.
Okay, thank you. Well, I'm very pleased to be here, and thank you for the introduction. I guess you all know what's going on outside this room today, and it's going to probably have some effect on tax policy for the next 4 years, and also some of the issues that you're talking about. So I'll get right onto it. We'll see what the New York voters have decided later tonight, but in the meantime, they are faced this year with a choice, and I'm just going to frame the big picture and then talk a little bit about the business and international provisions of the candidates. So the big picture is always in tax policies. We spend a lot of time talking about how to design tax systems, how to work on particular rules. We're usually thinking within a very narrow framework where the government needs a certain amount of revenue and the distribution of tax payments is going to be distributed pretty much the way they are now. However, the candidates are not thinking in that narrow framework. There are very, very big differences on the two issues that probably matter most in tax policy. That is, what's the size of government and what's the total tax burden on the public, and how is that burden going to be distributed among people in different income groups. So I'm just going to summarize some work we did at the Tax Policy Center, and you'll be struck by the huge differences among the leading candidates. Starting with Hillary Clinton, I guess she could be described as the status quo candidate. She would raise revenues by $1 trillion over the course of the next decade. That's about 0.5% of GDP. That's really roughly equivalent to the revenue increases that have been proposed in the Obama administration in recent budgets. And so it's pretty standard Democratic policy, modest increases in taxes. On the other hand, if you look at Cruz and Trump, they're going to cut taxes over the next decade by either $8.6 trillion in the case of Cruz, $9.5 trillion in the case of Trump. That's almost or exactly 4% of GDP. So that would be a massive tax cut, much bigger than the ones that were as a share of the gross domestic product in the tax cuts in either the Reagan or the second Bush administration. So that's a big shift. They have not specified how they would cut spending, how they would finance this, other than to say they would both increase defense spending and that Trump would maintain Social Security and Medicare. So you can imagine what the consequences would be for the rest of the budget. Now, take Bernie Sanders, that's completely the opposite. He would raise taxes by almost twice as much as the Republican candidates would cut them, by $15 trillion over 10 years. That's 6% over 6% of GDP in the next decade, 7% of GDP in the following decade. Other than World War II, that's certainly the biggest tax increase we've ever had in the history of this country. but it wouldn't reduce the deficit. We haven't done estimates of their spending, but others have suggested that their spending, the proposed spending, including free health care for everyone, free college tuition, and so forth, might add up to actually more than what they're raising in revenues. What about who's paying? Well, again, this is really dramatic. I think what's really dramatic is what's happening to the people in the top 1% of the distribution. That may be some of you in this room. Clinton would raise your taxes by about 3 percentage points. So she is proposing some tax increases at the very top, but pretty much no tax increases for anyone else. The only reason people in the lower groups are paying more taxes, according to our numbers, is that everyone bears some effect of increases in corporate tax payments, so that it is spread a little bit. But again, it's very concentrated at the top. On the other hand, Cruz and Trump would have massive tax cuts for the top 1%, pretty much lower taxes everywhere across the board. These are 2025 numbers, but very concentrated at the very high end. Sanders, again, is the mirror image of that. He would raise taxes by 21% in the top 1% of the distribution. That's taxes as a percentage of pre-tax income. And by the way, those figures include all federal taxes, includes corporate, excise taxes, payroll, and individual income taxes. But he would also have substantial increase in taxes throughout the distribution, including 8% of income tax increases in the middle of the distribution, and a little more than that in the upper middle. So those are very, very big changes in policy. So let me talk a little bit about the corporate and international proposals, which are probably more of interest to you. On Clinton's plan would be pretty much, again, status quo. She would eliminate some business preferences, but add some new tax credits, keep the rate at 35%. For flow-throughs, the rate would go up because there's a new high-income surtax mainly, which is 4% of individual AGI. She also has some tax increases on capital gains. As far as the international tax, there is no fundamental changes in the current structure, except that there are some anti-inversion provisions, which I'll talk about in the next slide. Cruz, let's go to Trump next. Trump, again, is basically keeping the current law structure of the corporate tax, but he's cutting the corporate tax rate to 15%. He's also going to tax flow-throughs at a top rate of 15%, compared to an individual tax rate of 25%. So there's probably going to be a lot of games being played in changing income from wage income to business income. Those actually are not in our numbers, so our revenue loss is probably going to be bigger than what we said. The interesting thing in the international area is that Trump will eliminate deferral. So he tax companies on their worldwide profits on a current basis. Now, since he's lowering the rate to 15%, the bite of that is not going to be all that big. But nonetheless, it is kind of consistent with a policy which seems to be the noises he's making on trade, that he wants to bring investment back at home and not give preferences to foreign investment. Let's go to Sanders next. Sanders would also keep the corporate rate at the same time. He would eliminate a number of tax breaks, including oil and gas tax breaks. For flow-throughs, he would raise the top rate to 52%. That's the top individual rate in his plan. And that's actually two parts. He's going to have a 28% rate on taxable income plus a 24% rate on adjusted gross income. So the second part is relevant because you don't get to take any itemized deductions against your adjusted gross income. So that's a very big tax increase for high-income individuals. On international, he would eliminate deferral, but also include anti-inversion provisions. So he would have a worldwide tax at the 35% rate. So let me talk a little bit about how these provisions affect inversions, and then I'll stop. I guess we can think in terms of carrots and sticks. What are the general effects of their proposal? Oh, I forgot Cruz. Let me mention Cruz. He is actually very significant, because Cruz would eliminate the corporate income tax and replace it with a value-added tax. He doesn't call it that, but that's what it is. It's a 16% value-added tax, and it would be a destination-based. So the taxation at the business level would have expensing and no interest or wage deductions, as would be the case for a value-added tax. Flow-throughs would be treated the same as corporations. They would be subject to this 16% VAT, and international would be destination-based. So let me go to the next slide, and I'll finish. What about inversions? Well, you can think in terms of carrots and sticks, incentives to invert, and anti-inversion provisions. It's easy to start with Cruz. There'd be no incentive to invert in Cruz. It's a destination-based tax. Wouldn't really matter where the company is domiciled in terms of the tax burden, and so therefore there are no anti-inversion provisions. There aren't any needed. Clinton would basically leave the incentive to invert unchanged from where it is currently, but she would have a number of anti-inversion provisions, including a 50% ownership threshold for recognizing an inversion, limits on interest deductions beyond those that were regulated. This would be legislation. And also a new wrinkle, she would have an exit tax, which, as I understand it, would mean that companies that invert, and also companies that are bought, which are not the inversions, would have to pay a tax on a current tax on the accrued value of their assets held overseas. So it would be as if basically a deemed repatriation and a tax at the current corporate rate when they invert. So that's a very strong disincentive for companies to change their residence. Sanders would increase the incentive to divert substantially, because he's eliminating deferral, which would make, I think, all companies not want to be US based. But he would also make it harder to invert, have the same limits, some of the same limits that Clinton proposes. In addition, one other wrinkle, he would change the definition of corporate residence. So instead of just being based on the place of incorporation, there would also be tests relating to the location of the place of management. So in order for a company to actually change its residence, it would have to do some real things and not just get a different address for the corporations. Finally, Donald Trump has no specific anti-inversion provisions that we're aware of. His proposal is on the effect of the incentives to redomicile are ambiguous. He's lowering the rate, which would reduce the incentive, but he's also eliminating deferral, which is increasing the incentive to invert. So at this point, I'll make one last comment. There are a lot of other proposals on the table on the Hill, and I think they're kind of much more realistic. The most popular one, the international-only reform, would eliminate the repatriation tax. It would impose a minimum one-time tax on intangible profits and a one-time tax on the unrepatriated profits, and it would tax going forward intangible profits at some low rate, some minimum rate. A bunch of proposals have these features. They differ, though, greatly in terms of the rate that would be imposed on the minimum tax and the rate and the scope of the tax on unrepatriated profits. So you could say the different parties agree in principle on these three provisions, but they don't agree on the rates, and they don't agree on how much revenue they think they would like to raise. Mr. Hatch is talking about a corporate integration proposal, which I understand would be a dividend deduction with a withholding rate. At the same time, he would eliminate the special favorable rate and tax dividends at ordinary rates. A big issue in the Hatch proposal is what to do with about nonprofits That I guess they're still wrestling with that, but we will be expect to see a proposal from Hatch within the next month or two. So that would be a very interesting development. So there's a lot of activity, a lot of serious discussions going on Capitol Hill. I don't expect anything's going to happen this year, but it's going to be interesting to follow those developments. And at this point, I'll stop.
All right, well, thank you. It's good to be back here again. I was here last year and really enjoyed that. So I look forward to discussing what's really a follow-on to Eric's remarks, I think. Eric has looked at what the candidates are proposing and what Capitol Hill is discussing at the moment. I want to take a somewhat broader perspective, or longer-term perspective, I guess, and speculate about the options that the United States could face longer down the road as it continues to wrestle with the problems that I think are built into the corporate income tax. So in terms of the international corporate tax trends that we're observing, some of them have been talked about this morning: the efforts to combat profit shifting in the form of BEPS, the EU investigations, and the UK's diverted profits tax. I'm not really going to talk about the effects of those. I think that the panelists this morning had much more and much better things to say about that than I would be able to do. The statutory rate reductions that we're seeing abroad, which have not been imitated in the United States, I think is the other major trend, and the one that I'll focus on. It's well known that the U.S. statutory rate of its corporate income tax is now the highest in the developed world. A chart that was displayed earlier, I think, by another speaker demonstrates just how the other OECD countries have been lowering their rates while the U.S. rate has remained stable for some time. Of course, the U.S. rate here includes the average state corporate income tax rate. So what are the implications, broadly speaking, for the United States from these developments, and particularly from the fact that our rate is so much higher than in other countries, a trend that may well continue and be exacerbated in the future? Well, I think the broad effects are familiar to all of us, that we have a system where the taxation is based partly on the source of profits and partly on the residence of the corporation, currently defined by where the charter was issued or by the place of incorporation. And so we would expect that as the U.S. rate becomes higher relative to other countries, that we would see pressure put on all of these dimensions. We would expect investment and profits to move away from the United States. That could, of course, take the form in some significant part of changes in the location of real investment, and therefore changes in the location of where income is actually being generated. But of course, we know that another type of response, probably easier to implement in many cases, is profit shifting. We would also expect economic activity to move away from U.S. chartered companies. And of course, inversions are the aspect of this that has received the most attention, and in some ways, perhaps the easiest to deal with. We obviously have 7874, we have the regulations that have recently been issued. We have proposals by the candidates on Capitol Hill for measures to restrict inversions, all of them loosely speaking saying that if you used to have a U.S. charter and you have changed the charter of the parent of your corporate group through a certain type of transaction within a certain time period, we will treat you as if you still had a U.S. charter and tax you on that basis. I think that's not a viable long-run solution because it doesn't change the fact that the location of the charter really is not a viable tax base, and simply trying to look at the past location of the charter instead of the current location is not a long-run solution, although it may well be a desirable response in the short run to the difficulties that the current system faces. What other types of responses does the high rate and the charter-based definition of corporate residence impose? Well, there's the tendency, which I don't know that we've seen it to a great extent yet, there have been isolated examples of where initial incorporation should occur with a foreign charter instead of a U.S. charter. I think that's probably the next shoe to drop. It always used to puzzle, I think, many economists, maybe many lawyers too, I don't know, why there weren't more inversions in past years. And in the 90s, of course, we began to see a few of them, and then the tempo picked up. And really the puzzle was why they hadn't occurred sooner, not why they occurred at all, but why it took so long. And so the next logical trend, I think, is that any company that thinks that it may become multinational at some point in the future probably is well advised to begin its life with a foreign charter instead of a U.S. charter. And here, too, I think the puzzle is like, why aren't we seeing that yet? Why are we not largely seeing that? And at what point will we perhaps see that? But of course, aside from that response, there's also simply the loss of competitive position, that imposing higher tax on investment that's done through a U.S. chartered entity than through a foreign chartered entity will naturally cause some relocation of activity from U.S. chartered entities to foreign chartered entities in the form of a loss of competitive position within particular industries. And so I think all of these trends are going to put pressure on the corporate income tax. There's been discussion, of course, about reforms that you can make within the context of the corporate income tax. Should there be a minimum tax on profits earned abroad? Should we not tax repatriation and instead tax the income as it's earned by the subsidiary through some type of expanded Subpart F, and so on? Should we restrict inversions? A lot of these things may well make sense as incremental steps to address the challenges of the current system, but none of them really wrestle with the fundamental dilemmas here. Most of them, if they ease the pressure to book profits and invest abroad, tend to increase the pressure to charter abroad and vice versa as you move between the poles of the territorial and the worldwide system. So I do believe that in the near and medium term, the United States probably will either stick with the current system or will make those kinds of incremental changes. But I believe that longer term, it will be necessary to look at something fundamentally different in how we try to tax the income that originates in corporations. And so 10 years, 20 years down the road, we will see structural alternatives being considered. And so I want to discuss those briefly today. All of them could merit a much more extended discussion. One of them, for example, I've co-authored a book about. So obviously today's discussion, in the few minutes that I have, will be a thumbnail sketch, far from a complete discussion. And as we'll see, I think each of these options has some significant attractiveness to it on economic grounds, but all of them pose substantial challenges in moving to that type of system. So none of these are simple, straightforward solutions that we could just do at will. We would need to seriously ponder the advantages and disadvantages of each option and how to move towards it. And it's certainly something that is going to occur in the longer run, not in the near term or perhaps even in the medium run. So the options that I'll discuss today very briefly are moving away from taxation at the corporate level towards shareholder taxation, and various ways of moving towards consumption taxation. And I'll consider three sub-options under that, involving value-added taxes, involving the Bradford X tax, and involving the personal expenditure tax. So shareholder taxation, although certainly a sweeping change, is less sweeping, I think, than the other options that I'm going to discuss. And as many of you may know, Eric Toder and I are, in fact, have put forward a proposal in that regard back in 2014. We're actually refining and modifying that proposal and expect to release a revised version of it in June. But the idea is to either eliminate or substantially reduce the corporate income tax, and then to increase the tax on shareholders, which would be likely to involve taxing both dividends and capital gains on corporate stock at ordinary income tax rates. The economic appeal of this, I think, should be straightforward. As long as we're taxing at the corporate level, we have to base the tax either on the source of the income or on the residence of the corporation, however that may be defined. And it seems clear that both those tax bases can pretty easily be manipulated, and probably will be manipulated to an even greater extent in future years. In contrast, the shareholder tax could be based upon the residence and or citizenship of the individual shareholder. And although it is certainly true that shareholders, like other individuals, could renounce their citizenship and emigrate, it would seem that's probably a less sensitive, less mobile, less distortionary tax base than the residence of a corporation or the source of its profits. That it's a lot easier for a corporation to move if it means getting a piece of paper issued by a different governing authority than it is for a shareholder to actually uproot themselves from the United States and change both their citizenship and their residence. So I think the appeal of this should be clear-cut. Nevertheless, the challenges are formidable, and certainly Eric and I have become aware of those as we worked both on our original proposal and on the current revision of that. So one challenge, of course, is how and whether to tax foreign investors who are deriving profits from within the United States. We have discovered that there's a strong, visceral support for the idea that foreigners deriving profits from the United States should be taxed. And furthermore, that actually has a good economic grounding. If one believes that U.S. tax policy should serve the national interest, then it makes perfect sense that the United States should try to extract some of the rents that foreigners derive from investing in the United States. It wouldn't be feasible to do that if the United States was an infinitesimally small part of the world economy and was a perfect substitute for other investment locations. Needless to say, that doesn't remotely describe the United States. We're a large part of the world economy with a number of unique attributes. It therefore follows that it is feasible to extract some rents from foreign investors, although the current level of tax on foreigners investing here is almost certainly excessive and driving investment abroad to a large extent. It does make sense to put some tax on them and accept some loss of investment in the United States in order to transfer that revenue and those resources from foreigners to Americans. Revenue loss is an issue. If you completely eliminate the corporate income tax, you cannot replace that revenue simply by taxing capital gains and dividends at ordinary rates, and that is partly because so many shares are held by tax-exempt institutions, retirement plans, and foreigners. There's a challenge what to do with business tax preferences. There's other challenges. I won't mention really transition on any of these reforms, but transition is always an issue for every big reform, so that should just be taken as understood and stipulated from the get-go. As I mentioned, if you weren't taxing at the corporate level, you would want to dramatically raise rates at the shareholder level, probably to ordinary income rates. Now that's fine for dividends, and of course until the 2003 law, that was how dividends were taxed for the most part in the United States. But raising capital gains tax rates to ordinary rates is formidable, poses formidable problems. There would be a lock-in effect of people being reluctant to sell shares in one asset and move to another asset because the sale would trigger tax, and it would be possible to shelter profits within a corporation if the corporate tax rate was zero or was low. There are two ways to address this, both of which are somewhat far-reaching. One is to continue to tax capital gains only when they're realized, but to impose a deferral or interest charge to make up for the fact that gain wasn't taxed as it was accrued. The other possibility, which Eric and I embraced in our plan, is of course to do mark-to-market taxation on publicly traded stock and to tax the gains and deduct the losses as they accrue. And I won't go through here the challenges that option imposes or that the deferral charge imposes. Obviously those challenges exist, such as volatility in the case of mark-to-market taxation. The value-added tax is a long-standing tax idea and of course implemented in many, many countries around the world, at least 160. It has been periodically proposed in the United States, most recently by Rand Paul and Ted Cruz, although like many other people proposing VATs, neither of them has been willing to use the V word, and both of them in fact denied, and Cruz continues to deny that it actually is a value-added tax. Because the VAT is regressive, it would not be feasible, I think, politically or desirable normatively to have it completely replace the income tax, and so most proposals call for it to be adopted alongside the income tax, perhaps scaling back the income tax, but definitely keeping the income tax alongside the VAT. It does pose a number of design challenges, such as how to tax financial institutions, and again the transition issue. There's also a concern, which may have some validity, though maybe not as much as some people believe, that it serves as a money machine that would lead to an inefficient expansion of government, perhaps because the tax might be relatively invisible or not noticed by the people paying it. In part, that would depend, of course, upon whether it was listed on customer receipts, but the concern might still persist even if it was so listed. So the VAT, because of its regressivity, probably could replace only part of the income tax system. Nevertheless, it would be feasible to replace the entire income tax with a progressive consumption tax. However, that would involve adopting a relatively unfamiliar tax system. There are two such systems that could be used, but both of them are unfamiliar to the American public, and one of them, the one I'm about to describe, is particularly difficult, I think, to describe and to communicate. And I speak from experience on this because I did co-author a book about this tax. We considered including a chapter or part of a chapter that would discuss how to effectively market this tax and explain it to a broad audience. The book does not, in fact, contain any such section, and the reason is because my co-author and I could not really identify the strategy that should be set forth. Now, that may perhaps reflect our limitations in that we are economists instead of marketing specialists, but I think it does also reflect some of the difficulties in describing this tax. The VAT, the X tax is a modification of the value-added tax, but it splits it in two. The value added of each business is equal to its business cash flow, which is its income computed using expensing instead of depreciation, and therefore is not income, but instead is cash flow, and plus the wages paid by the firm. So the Bradford X tax says, let's tax households' wages at graduated rates, progressive rates based on what the wage income is for the household each year, and let's tax the business cash flow at a high flat rate for all firms, probably equal to the top tax rate on wages. There are a lot of design challenges, which I don't have time to go into. I guess we're running out of time here. But it is, I think, an unfamiliar tax and perhaps not intuitive. It doesn't look like a good income tax, and it's not, because it's not an income tax. But it also doesn't really look like a consumption tax. And that's a problem because it is a consumption tax. And I think in normative terms it's a good consumption tax, but you can't really convince people of that unless they see that it's a consumption tax. And it's really not clear because the consumption is being taxed in two different places. Wages in one place, business cash flow in another place, and neither of those alone is consumption, only the combination of them is. The personal expenditure tax is also unfamiliar to Americans, but it is considerably easier to explain. And so if we were to go the route of progressive consumption taxation, I think it might be more likely to come about, which is not to say that either type of tax is particularly likely to be adopted. The personal expenditure tax is a graduated rate or progressive rate tax, but it applies to a household's consumer spending each year, which makes pretty visible and intuitive that it is a consumption tax. Of course, this is not computed by asking households to keep all their receipts or to keep a diary and record all their consumer purchases, but instead is computed by starting with income and subtracting all saving and then adding all dissaving. And it's absolutely imperative that both steps be undertaken, not just the first one. The answer, if the calculation is done correctly, of course, is the household's consumption before tax, and that could then be taxed at graduated rates each year based on the level of the spending. And here, too, there are design challenges, and one aspect that I think may rub people the wrong way, and that is that borrowing proceeds, of course, would be included in the tax base because that is a conspicuous form of dissaving. And those would need to be added in, something that does seem to rub many people the wrong way. Note, however, that all payments made on the borrowing, both interest and principal, would be deductible as they're made, which would, I suppose, soften the sting of having to include the initial borrowing proceeds in your tax base. So what do I think might happen? Well, the future is hard to predict, as Dan Shaviro mentioned and as Yogi Berra said, so I speak with some trepidation. The shareholder taxation, I think, is something we may well see a move towards in upcoming decades, although it's likely to be considerably more modest than eliminating corporate taxation entirely. Because so many countries have a value-added tax and because our fiscal needs are going to grow in upcoming decades due to rising Social Security, Medicare, Medicaid, and healthcare spending, I think that we are likely to see renewed interest in a value-added tax being adopted as a bipartisan compromise at some point. The X tax and the personal expenditure tax, I believe, are less likely to be adopted. So why don't I stop here, and I think Eric will come forward, and we are ready to take questions directed to either or both of us. And our understanding is, I guess, that we will call on people who have questions, and a microphone will be brought over, as was done in the earlier sessions.
Did we explain it that well?
Perhaps. Here we go. Back there, yes.
Hi. My question has to do with the repeated assertion about how high our corporate tax rate is in the U.S. and we compare it to foreign jurisdictions. However, isn't the real question the effective tax rate of corporations incorporated in the U.S. rather than the statutory rate, which very, very few corporations in the U.S. actually pay?
do you want to?
I'll make
We'll
a
put
stab,
both,
and,
yeah, both.
and you can
We'll both address
you
it, but
can
why don't you go
follow.
first?
I think the answer is the question depends on what question you're asked. What are you trying to compare for what purpose? If you're interested in what's the incentive to report profits in the United States relative to reporting them somewhere else, you are concerned about the fact that the U.S. corporate tax rate is higher. If you're concerned about the incentive to invest in the United States relative to somewhere else, you're concerned about effective tax rates, but not on the total rate U.S. multinational companies are paying. You're looking at the prospective rate on what a company would pay, either U.S. or a foreign company, on the return to a new investment in the United States relative to an investment somewhere else. If you're concerned with whether we're taxing U.S. multinationals in a way comparable to foreign multinationals, then we might be interested in the statistic you mentioned. So it really depends, what question are we asking? And for some purposes, the statutory rate is very important.
Yeah, I think that my answer would be the same. I mean, the statutory tax rate is the absolutely critical measure for purposes of looking at profit shifting incentives, but it's not the right measure for things like the investment incentive, at least for investments that don't have a high degree of above normal returns. For the ones that do, the statutory rate becomes more relevant there as well. The United States is an outlier when it comes to the statutory rate, and less so when it comes to the effective rate. It's, of course, hard to measure the effective tax rate. You have to look at different types of investment and make different assumptions about the financing method and so on. You know, my reading of the evidence is that the United States does not have a particularly low effective tax rate, although some people have claimed so. On the other hand, it's clearly not the highest in the world the way the statutory rate is. The picture obviously does look better if you're looking at the effective tax rate instead of the statutory tax rate. I do think that as other countries continue to lower their corporate income taxes, if the United States does stand still, then of course our statutory rate will become even more out of line with other countries' rates, and our effective tax rate will also move up relative to other countries. And so at some point we will have to decide how to really deal with the underlying challenges of basing tax on corporate residence and or source of income.
I would also say, when we were talking about the rate on new investment, that Alan, in saying the effective rate matters most, is giving an economist's answer, which would be my instinct. But then the view of a lot of accountants and business people is that the statutory rate might matter more. The effective rate is lowered by things like depreciation, accelerated depreciation deductions. That's one reason our effective rate on new investment isn't that high. But then accountants would book that as deferred tax liabilities, and so it wouldn't show up as a reduction in book income of corporations. And so if corporate managers are more worried about the book income than the actual after-tax income, they might take a different perspective.
Well, we ought to get it.
Dollars are dollars, and segregating the rates you're talking about into pockets doesn't really help the analysis.
Well, I mean,
you can-
the pockets and the labels don't matter, but who pays the tax matter. The incidence of payroll taxes is on workers, not on the companies. That's true for the employer share as well as for the employee share. There's possibility of different results in the short run following a change in payroll taxes, but in any kind of medium run or long run equilibrium, the business has to be paying lower wages because of the employer payroll tax liabilities that it has. So we want to look at the tax burden on investment. We want to focus on the taxes that apply to that investment. So we would set the payroll taxes aside for that purpose. Of course, the payroll taxes have their own set of effects. First of all, they penalize work, as nearly all taxes do, including consumption taxes and capital income taxes. And of course, they also are important from a financing perspective for the social insurance programs to which they're dedicated. Actually, there's a whole other topic that would be interesting to talk about in terms of the problems that are raised when people propose eliminating payroll taxes without addressing how that would affect the programs that those taxes are earmarked to. And this is, I think, a limitation of Ted Cruz's plan, as he would repeal payroll taxes without addressing the implications for Social Security. But in terms of looking at the tax rate on investment, we don't want to include the employer payroll taxes.
Yeah, I'd also make the point that although we do in our analyses treat the payroll taxes as a tax, they're not 100% a tax, because this is one of those things where you pay more, you actually accrue more benefits in retirement when you pay the tax. I think there's not a perfect correspondence. We did some simulations which suggest about a 55%, the Social Security tax burden is really about 55% of the tax rate because of the offsetting benefits that individuals receive. Now, it's very uneven depending on your future earnings, your marital status, and a whole bunch of other things. But
I mean, an interesting question on that front is, of course, the extent to which workers either do not perceive or misperceive those incentive effects. It's certainly unlikely that most workers understand how additional wages in any given year affect their Social Security benefits. The benefit formula for Social Security is not well known or well understood. I've always wondered whether workers tend to underestimate or to overestimate the linkage between their wages and the benefits they receive, and I honestly don't know the answer to that. And therefore, of course, unless we do, it's hard to know how that affects their actual labor supply decisions or whether there is any such effect. There's also another complication, of course, is that computations like the one Eric mentions are, of course, done using the current law benefit formula. And, of course, no worker can be certain that formula will still be in effect when they reach retirement age. So that's a very complicated area.
Yes, thank you. If you watch any kind of business TV and senior executives are interviewed about the whole inversion problem, they invariably say we need to have a territorial tax system in the U.S. like the rest of the world, and inversions will stop, which I certainly agree with them they would. How that would encourage investment in the United States, I don't quite make that logical step. But assuming they're able to repair this whole fracture in the free trade consensus and eventually get what they want, which is territoriality, how do you address that and still have a viable tax system?
all right, I think we can both answer that.
Yeah.
I'll take the first crack. I think the first statement is it's actually not correct to say that a territorial tax, in the way some people are thinking about, alone is going to stop the incentive to invert. And as we discussed earlier today, there's a tremendous advantage to being a foreign-based company because of your ability to strip profits out of the United States, and just simply eliminating the tax on repatriated dividends is not going to change that. So there would have to be much more than just going to a territorial tax. Also, I think when you talk to people, and I've talked to business people about a territorial tax, they throw that out as a mantra, as a slogan, but they don't realize that nobody really wants to have a system in which there's no tax on foreign source income, and that just makes it possible for profits to be shifted overseas in an unlimited way. So all of the proposals out there have some kind of accrual tax on foreign profits. And of course, once you put that tax in, you're again penalizing U.S. companies. You're just doing it in a different way. So I don't really think that a territorial tax, it certainly helps, but it creates other side issues and is not necessarily a panacea for the inversion problem.
Yes, I think the question is a good one. I mean, it highlights the conflict in the policy goals that I mentioned earlier. As long as we're staying within the framework of the corporate tax, moving towards territoriality is likely to reduce the incentives to invert. But of course, far from increasing the incentives to invest in the United States, it actually reduces those incentives, and it gives U.S. chartered companies more of an incentive to invest abroad if there's no residual tax on those profits. So at the same time that you're supporting the goal or advancing the goal of preventing inversions, you may be undermining the goal of bringing investment to the United States. And if you go in the opposite direction towards the worldwide system, you've got the opposite set of effects. So in each case, you're making one problem better, while making the other problem worse. And that's why I think in the long run, we're likely to see a movement away from corporate taxation and towards one of these structural alternatives.
Yes, good afternoon. First of all, the analysis that you presented on the presidential candidates' tax policies is directionally consistent with a lot of other studies that are out there. But my question has to do with what is the long-term impact on the U.S. economy in your view of these various plans? For example, current CBO estimates suggest that if we maintain status quo and do nothing, given where Social Security and Medicare spending are heading, we will have to raise taxes 4% of GDP by the year 2040 or 2050. So given these tax policies layered on top of that, what will be the impact on the U.S. economy in the long term from their various policies?
Well, you raise a very, very important point. All of these policies are being put forth in the context of a long-run budget situation, which because of the aging of the baby boomers is quite unfavorable going forward. And either we will need to have more taxes or we're going to need to reduce some of the promises that have been made in Social Security and health programs, or both. And that's the unpleasant mathematics that we're facing, that there isn't a single candidate who's really addressing that, unfortunately.
Well, yeah, and of course, the worst thing is that we look at the Cruz and the Trump and the Sanders plans, and they're really adding to the deficit. We've seen the large revenue losses in the Cruz and the Trump plans, which really exceed what was previously viewed as, an acceptable revenue loss, even for a campaign proposal. And Sanders, again, initially seems encouraging because there's a lot of revenue coming in that could reduce the deficit. But I think all the estimates that are really done from a fair-minded perspective show an even bigger spending increase that would offset it. So those three candidates' plans are really adding to an unsustainable fiscal situation. And the consequences of that economically are very harmful indeed. The Cruz and the plan particularly, and the Trump plan as well, hold out the promise of increasing the incentives for saving and investment because they lower the marginal tax rates on capital income. Those effects are going to be swamped, however, by the deficit spending that those plans involve as the deficits crowd out capital accumulation. It's just impossible to see coming out ahead on that kind of equation. And of course, with the Sanders plan, I think it's a double-barreled problem because you have increased disincentives for saving and investment combined with deficits originating on the spending side. So it's really the long-run economic impact of those plans has to be harmful, unless there's unspecified offsetting measures that the candidates simply haven't said anything, to the voters about. So I think those plans are very disturbing. None of the candidates, including Clinton and Kasich, have really laid out a plan for how to address or correct the imbalance that's already built into current policy. But I think the Cruz and the Trump and the Sanders plans are particularly alarming in terms of how they would dramatically exacerbate a imbalance that's already quite severe. Well, it looks like we're out of time. Thank you all very much.
Thank you.